So some people will tell me when I get older, I'm going to retire. So I'm going to make less money. That's why I want to defer my taxes till later. But what they're not factoring in is that the IRS has thought about that and they always want to get their money too. We have to understand a fundamental rule about taxes. Every dollar gets taxed once, okay? And so keep that in your mind as we talk about what a retirement account, what really investing actually is, right? When you're investing in something, what you're doing is you're buying something of value and you're hoping that it turns into something of far more value down the line. That's why you're doing that. So like in that way, you're really not any different than like a farmer who's planting seeds. Obviously, seeds aren't worthless, but the real reason why you plant those seeds is so that it blooms into a beautiful harvest so that you can make some money off of it down the line. Now, let's bring that back to our fundamental rule of taxation. You're going to pay taxes one time. And so, what you're allowed to do within these retirement accounts is you can decide to pay taxes at the beginning on the seeds, or you can pay taxes at the end on the harvest. This is the difference between a traditional contribution and a Roth contribution. Roth contributions are going to pay taxes on the seeds, and traditional contributions are going to pay taxes on the harvest. But what's going to be worth more, the seeds or the harvest? The harvest is certainly going to be worth more. So if you're going to pay taxes once, why would you automatically choose to pay taxes on the harvest versus the seeds? Most people are choosing traditional 401k or 403d contributions. Means they're getting the tax break up front, they're not paying taxes on their seeds to pay taxes later on the harvest. As opposed to Roth contributions, which is paying those taxes up front and then not paying any taxes on the harvest. Again, you pay taxes one time. Why do you think most people do that? To me, the easiest explanation about that is that the Roth contributions and 401k accounts really started happening in like 2006. And so our industry is one that's really old. And so people just don't change what they already know. And so a lot of people have been following this like old advice or this old system, but like the system has changed, but the behavior didn't. But what practically happens is once you do get older, you have to take out something called required minimum distributions. Effectively, what that is like the IRS is giving you a tax break on all this money that you defer taxes on under traditional contributions. And so it's growing, it's growing, and growing. And they want to get paid at some point. So they're going to say, hey, you now need to take out a percentage of your account every single year. It ends up being about 3.5 to 4% once you hit age 73, as the way the law stands now. And so what that means by saying that you have to take money out of your account, they're saying you have to realize this as income, i.e. you have to pay taxes on this now. That's going to increase your taxable income, which will then put you in a higher tax bracket as if you were working anyways. And on top of that, the money that's actually going to be taxed, even if the tax rate is lower, the account balance is going to be significantly higher. The way historically investments have worked is that they've historically doubled every 7 to 10 years. So if you put $100,000 in at age 30, by the time you are 60, that would have historically at least doubled 3 times. So that $100,000 is now 200, 400, $800,000. So you're paying taxes on $800,000 versus paying taxes on $100,000. And that's really conservative estimate. So the math just doesn't really pencil in any way. In addition to that, if you pass away with any money in a traditional retirement account, the IRS is going to mandate that your beneficiary takes that out within 10 years, i.e., they're going to mandate that the beneficiary pays taxes on that, income taxes, within 10 years. Now, a Roth IRA actually, and for a Roth 401k, never has to pay R&Ds. What that effectively does is that turns your retirement account balance into an income stream as if you were working. So your income is now back up.